She probably will.
Yes, I
okay.
will.
All right. So as we are getting this going, instead of having a bit of awkward silence, we're just sort of stalling until we get the okay, so that when it starts, we're not all sort of looking there at the camera. I do see that you both have whiteboards behind you, which is very particular. So are whiteboards part of your magic?
It's not actually a whiteboard. We in our meeting rooms, we can actually draw all over the walls. So
even better.
There's usually remnants of about 5 different discussions all over the place.
And do you find that the writing on the wall works? Is it a little bit more startup-ish, as you know, let's just write on the wall as opposed to the board? Does it feel better?
Yeah. I think there's a design choice in there as well as a functional choice. But nice. Yeah, it's quite cool.
And how important is having the ability to write on walls when it comes to scaling up finance? you get the lines going upward, right?
Yeah, I guess so.
Well, we are now officially live, and I want to welcome everybody. We're talking not only about whiteboards and writing on walls, but we're talking to these ScaleUp Heroes here on the ScaleUp Hero podcast. And it's where we bring the best minds with the best experience to basically show those startups who are past the startup phase, but into the scale-up phase. And today we're talking about money. And we're going to talk, it's going to be more of a fireside chat. And we've got Noelia Podadera. I messed that. I had it good in the rehearsal. Say it again and I want to repeat it. What is it?
Noelia Podadera.
Noelia Podadera. All right, we're close at that time. And then Dave McKenzie. And Dave is the head of finance at Curve, and Noelia is the CFO at Packlink. Now, my name is Ryan Foland. I'm your host. I want to encourage you to be engaged on our Facebook Live, make comments and like. And if you have any questions, you want to see other Scale Up podcasts, go to scaleupacademy.io. That's scaleupacademy.io. I'm going to be a ginger fly on the wall, and I'm going to be chirping in with some comments. I'm really interested because it is all about the money. You run out of money, you run out of business. So Noelia, I will let you take it away, and we can now sit on this virtual fireside chat from around the world.
Thank you very much, Ryan, for this nice introduction. So I'm Noelia, and I'm currently CFO at Packlink Shipping. Previous to that, I spent almost 10 or more years in a traditional, conventional blue chip company, Siemens, Germany, Spain. And after that, I switched to the online e-commerce, new world startup in Germany, Dress for Less. It was an online retailer for brands, fashion, clothing. And then I came to Packlink, where we have a shipping comparison website and have a business for the B2C as well as for the B2B segment. And happy to participate today in this growth sucks cash. That is a statement accompanying almost all startups, and would like to ask Dave to introduce himself and tell me what he thinks about this statement and what he would propose to deal with these tight cash situations or distressed financial situations even, and how to avoid, measure, or deal with it.
Sure. So my name's Dave McKenzie. I'm the head of finance at Curve. I've been at Curve for a few months now, but I've been working in fintech really since before people used the word fintech. I was at a company called Prepay Solutions for around about 7 years. That was where I cut my teeth really, and moved on from there. Spent 2 years at a smaller payment startup called Bankable, and then recently joined Curve. So I'm sort of embracing the challenge of joining a company that's really sort of firing the rockets, as it were. And it's been an interesting experience coming in and really having to get to grips very quickly with cash position. It's obviously there's that, and then the unit economics of the business. So how much does it cost us to onboard a user, and then how long does it take us to get that money back in revenues and in profit? So I absolutely agree that growth sucks cash, and we keep a very close eye on our user acquisition metrics, and then once those users start using the product, how we can sort of get that back and basically turn that into more growth, and managing the cash position from there. So at the moment, it's mostly equity funded. There's no real debt in the business at the moment, but obviously that's one way you have of sort of combating that sort of cash challenge, if you like, but it's not something we're doing at the moment.
So if I understood correctly, you are in a growing company and your growth or your business plan is so far programmed to be funded with the equity, and you are generating already profits that gives you room to go further with your business plan.
Yeah, I mean, the challenge that some businesses have in the fintech space, especially in the consumer space, is that some products run sort of negative contribution margins. So for every user they onboard, they're actually losing more and more money until they're sort of trying to get to that position of having enough users and having a well-developed product where they can start thinking about revenue. Whereas at Curve, we want to, we take a slightly different view where we want more users and we want to improve the product, but we want every user we add to add value to the business. So the view we've taken is that there is spend on user acquisition in that respect, but we think we have approached the challenge better than some of our competitors of making sure that we're actually selling a profitable product.
Okay, so in this situation or this constellation, I assume your major spendings for this user acquisition to grow the company is about marketing more than about development, perhaps, or
it's
areas. Or
yeah, it's both. So there is some marketing spend. We do target specific demographics through the channels you might expect. But the other thing about growth is you have to be ready for the growth when it hits. So probably one of our biggest costs is staff, as with most services businesses. We have a lot of software engineers, both building products, building new features, and fixing any bugs that come up as normal as the product develops. So I think part of the challenge with growth is being ready for it when it happens. So it's all very well and good, when you're smaller, you've just got a couple of super talented software engineers writing amazing code, but then if all of a sudden you onboard, tens of thousands of users, then or more, you have to be ready for that. So for me, a big part of the growth is not just sort of those unit costs of getting people on board. It's building a structure that's ready for the growth, because if you're not ready, then a lot of companies struggle with sort of, they fire the rockets, they have amazing growth, and then all of a sudden they can't cope with the number of users trying to use the platform, both from a stability perspective, from a customer services perspective. So when I came into Curve, we redid the whole budget as a senior leadership team, really with involvement from all aspects of the business. So it was, okay, so our plan is to get to this many users. What does that mean to us in terms of number of customer experience staff that we need? What does that mean to us in terms of support staff, as well as, how many sort of people do we need to get in to build the product that will get us that many users? So it can't just be focused just around the technology or whatever the product is that you're selling. You have to make sure that the whole business is ready for the scale up when it happens.
Yeah, exactly. So sounds very familiar. Keyword, budgeting, business plan, measuring everything you're doing and adapting to real life. So whatever you can imagine in a budget, you have afterwards see what is really happening, what is really coming back. And have you, in your process of budgeting, also set a kind of not only the goals and the measures for the strategy you want to follow, but also the kind of stop losses if it comes to it? Have you put limits to these, for example, user acquisition metrics? How much are you going to lose? How far can you go until you have to say, stop it and turn off, invent all the strategy in order to not go further into a big or worse hole where you can't go out anymore?
Yeah, I mean, well, as you've already pointed out, a budget is only true on the day it's written, and then then it becomes something else. So yeah, we do have some key metrics we track in the business. We have user retention and usage metrics that we track as well alongside our profitability metrics. And you're right, there is also, I wouldn't say we have a strict sort of stop point in for when we would stop doing something. I think rather what we do is it's more iterative. So we will make the changes that we've planned. We will then measure the impact of the change either in terms of user growth or in terms of the profitability we would expect, or the specific sort of KPI that's been attached to that change. And then we will adapt. I mean, in terms of marketing spend, obviously there's a marketing budget, but we go beyond that in terms of, you've got to measure the efficacy of what you're doing. So it's all well and good throwing money at marketing, performance marketing, and those sorts of things. But if you're not measuring what they're doing with the money, then you may as well, pour it down the drain. So again, alongside the measuring the marketing spend, it's what's the cost per install? How are people flowing through the funnel? Are they turning into end users? And is it the users that we want? Are they using the products in the way that we expect? So it's a lot more iterative and it's a lot more data driven than just having sort of a classic, well, once the losses hit this point, then we stop. I think certainly the industry that curves in, it has to be the analysis has to be a lot more detailed. It's very difficult to set sort of a hard and fast rule for when you switch and move to something else.
So you just track your KPIs and see the tendency of them and how to improve or foster them with further investment, or rather rerouting where you are getting more benefits. So what about the classical KPIs? These the days inventories outstanding. In your case and in the case of Packlink, we don't have inventories. That's one headache less, fortunately. Not having goods or huge assets consuming cash, but you probably have these days receivables outstanding or cash conversion cycles. Do you measure this, or is this more done intuitively by you, controlling cash on a weekly, daily, monthly basis, or the 13 weeks?
Yeah. Fortunately, the industry we're in, I don't have to worry about cash being tied up in stock or in anything like that. In payment, sort of all of those sort of the cash turnover and throughput happens very quickly. So you're not waiting 2 months to get access to your revenues or anything like that. It's all flowing through quickly. So we don't have the sort of risk of non-payment by our customers that perhaps in other industries you would have.
Okay.
Especially, we're currently sort of focused more on the consumer market, and any revenues that are collected immediately from credit card or debit card. So there's no risk on that side of things. So that for us, the cash is more, the challenges on our cash flow are more really managing that cash burn with regards to user acquisition. And obviously we also have some key suppliers that need to make sure we pay and all of those sorts of things. But yeah, we're fortunate not to have cash tied up through a sort of long work in process channel. we make a sale and the money's there.
Okay. Have you tried to improve in some way working capital through even granting more promotions to your customers, to incentivize this prepaying, or to incentivize or to bundle suppliers so that you can perhaps get paid later? Have you ever counterbalanced the effects of paying sooner to your suppliers against paying less, so having less costs, or the other way around, trying to pay a little bit more but have days of...
Yeah, so in the past, in my previous experience, there has had to be times where the cash has been tight for one reason or another, and then we sort of looked to, yes, you can negotiate with key suppliers to say, especially if they're sort of a much larger player than you, often, especially if you're sort of, even though you're a smaller client, sort of companies like to work with fintechs, so you can sort of leverage that relationship to an extent, and sometimes suppliers are willing to extend payment terms if you need another couple of weeks. That's usually doable. On a more sort of systemic basis, also looked at sort of having financing deals in place with banks. You know, what I found is that while some banks sort of, it can be challenging sort of because there's a bit more complexity in the profitability of fintechs. It can be challenging to talk to them to get lending set up, but then there are some sort of very technology positive banks that understand the sort of the way the cash flows work when you're making a tech or a fintech product, and are willing to set up those sort of facilities that if you need the short-term financing, that it's available to you. So we have looked at those sort of things. I've never, in the past, I've never gone down the route of offering better payment terms for early payment to clients. I'd rather achieve that through sort of proper enforcement of payment terms rather than having to give discounts for companies doing something they should be doing anyway. You know, it's one thing to be paid late when there's been an ongoing discussion, and it's another thing to be paid late and have the your client just completely shut off all contact, which is something I've had to deal with before, and it becomes more challenging once you get into a situation with too many doing that. But what I found is that as long as you keep those relationships on an ongoing basis, and you make sure you enforce the payment terms that are in the contract and those sorts of things, that generally you tend to have much less problems than when you sort of, if you slack off and you don't chase for payment. That's often when you can end up with, you know, all of a sudden you're waiting another month or 2 months to get the cash. I feel like those things can be well managed as long as you keep in constant contact with them.
Yeah. So sure, I'm completely agree to the point that to customers, and also linked to technology companies that operate online and are e-commerce, are used to get money beforehand, because all these payment methods available in the market, credit cards and all these systems to prevent fraud or to check that the cards are really existing or that there are funds, is more or less common. And for little services or little things like, for example, what we have in Packlink shipping, if you just make a shipment of 5 to 10 euros or maximum 20 euros, if you go for an international European shipment, you pay in advance. That's no problem. So we also have a very low accounts receivables, or zero, only in the B2B sector. But this comes to the next question. Do you think there is a relationship between more liquid or cash effective businesses and profitability? Does it mean that you have less profitability, or that you have to renounce to margins if you get to the money immediately and have less risk in bad debts? And
I think that's probably very different depending on what sort of market you're operating in. I feel like sort of the space I work in, there's not really a clear link between the liquidity and the profitability. But I can certainly see that in some cases there may be sort of sometimes cash flow is used to improve relationships, or improving cash flow can only come as a factor of being at a large scale where you're able to operate, if you're manufacturing, where you're able to operate on just in time and those sorts of things. But I would say for me in technology, I think there's if the product is right, people are usually willing to pay for it, and they're usually willing to pay on time, which is probably not so much the case for sort of more, I guess, commodity type products. I think if you're selling a new product that's different, that no one else has, which sort of in the scale up sector, that's the sort of businesses you mostly expect to see, companies that are doing something a bit differently. I don't see the need for that link.
Yeah, I agree with you, but in my opinion, there is a point related to liquidity, that is cost of capital, that also it can impact your profit or loss for the year. It's not EBITDA, it's after EBITDA, it's your cost of capital, your interest, even your opportunity cost in your case, if you only have equity. But it's something to take into account, that if you are liquid enough and you don't need to get the finance outside, you can put this savings in cost of capital or financing cost into your margins, or out of your margins. The other question about, should we go for growth or should we go for margins? I think all startups have come to the point, how much should we spend in getting more users or more revenues if they are not profitable enough? As long as if you are funded and have equity, you can continue growing. And when it comes tight, you will be in a position to really be more efficient. At the end, if you have plenty of funds, you normally will spend and try a lot of things, and being prepared to pay more for things that you are not going to do if you are already at zero, or negative capitals, or even losing money, and have the pressure to go through these phases that companies has to face. And I think they are positive, because even being stressful, they bring you a lot forward, concentrating on what's really essential. And I think you are more efficient when you have less money than when you don't have to look at them.
Yeah, scarcity breeds hunger, as someone once told me. So yeah, when you have to really work for it when the pressure's on, I think it's always easy to spend money when you have it, and then when it's not and when it's not there anymore, then you have to tighten the belt. But I think certainly what I found is, as long as you have a real good handle on your cash flow, what your profitability really looks like, and what that will look like when you scale, you should be able to measure your runway, and you should really, there should never really be any surprises. And that's sort of, I mean, have you had to deal with any challenges where sort of the cash has got tight, and then how have you found your way out of that?
And yes, I had a very distressed situation in Westfalen in Germany, because the company was bearing a huge burden from a previous acquisition, where the loan was had been put over the operating company, and it came to a more difficult time where the growth was not as expected and the profits were not expected. So the cash generation was not sufficient for the lenders, and it came to a restructuring and renegotiating with a lot of bankers for this huge loan, because it had to be pushed into the future. And the way of improving there was to through inventories, tracking the inventory turnover, also the cash conversion cycle, and trying to get out more of the suppliers if paying anticipated, or the other way around, not anticipating the money, but paying later. So inventory has a very positive thing, that is that you can convert it to cash whenever you need it, even losing a little bit of margin if you run a promotion over it, and you can go faster for money.
Sure.
But on the other hand, you have obviously less margins if you start with promotions. No, that's clear. So yes, it was. And also in Packlink, we went through a not tight situation, but a situation where we had to readjust and say, stop spending where we really don't need it, and concentrate on profitability rather than on growth. Because we were already having so many users, and these users not generating all the profits they should. And therefore we reviewed a couple of things. But my last question would be, who is doing the cash, and who is in charge of all these KPIs? Is it only you? Is it you sufficiently involved? And is there enough transparency and visibility to this king KPI that is cash and cash burning or cash generating?
So, I mean, the responsibility is really, it's shared between me and the CEO. And we have to own that, and we have to, every month we have to justify what's happened. And if we make a decision that involves spending more money, there can be good reasons for that. But you have to be able to, like I said before, you have to be able to measure what you've done. We don't like, at Curve, we don't really like to operate on sort of gut instinct. That may be how you come up with an idea, but then when you execute it, it needs to be measurable. And I think we then sort of filter that out. So although the ultimate responsibility lies with the two of us, we can then, if we make a change, if we decide to do something, then the responsibility for making sure that money is spent correctly is on the team. It's on whichever team is spending the money. My view on the finance function is it's not sort of a little team that sits in the corner of the office, head down at the laptop. It works with the business, and also everyone in the business works for finance or in finance. So you should be able to share those responsibilities for measuring the KPIs and sort of justifying what's happened. It's not just the responsibility of the finance team. It's not just my responsibility. It's the responsibility of everyone in the business to understand how the company makes money. And if we do something to change that, then the team also needs to own that change and measure that change.
Yeah, very often CFOs are just the messengers. No, with the conclusions or with the outcomes of the initiatives that have been decided commonly. So I don't know, would you like to tell me also what would you implement to safeguard or protect the company? Probably already said in your answers, but how would you protect or safeguard a company in an expansion phase of getting into this stress situation?
Yeah, so I think we've probably touched on most of the points already. I think a lot of it comes down to relationship management with all of the different stakeholders. So if you have a large accounts receivable balance, that tells you something. If you have a large, having the debt facility available with your bank, keeping your bank with the board. So obviously Curve's major investors sit on the board, and every month we talk to them about the cash position, the financials, what's coming up, how has the forecast changed from last month? So I think ultimately everything boils down to the information and relationship management. If you keep all of the relevant parties informed, I mean, ultimately, some of it will inevitably come down to how the business performs, and people in the business need to own that. But as long as you have managed the relationships and you've protected yourself as well as you can, you make sure there's financing available if possible, if you make sure that you have maybe some suppliers that you've arranged favorable payment terms with. If things get tight, they understand your business. If your accounts receivables are in order, if it really comes down to keeping your eye on the ball more than anything else.
So it's all about trust. Exactly.
Yes.
The same when funding, it's also the same. If you can sell your product properly and they trust you, you will get the monies to do everything.
Sure.
Yeah.
Trust comes from performance. So if you can perform, then you generate trust.
Exactly. And cash.
Yeah.
Well, what a great conversation. And, we talk about you being the heroes. And one of my heroes is James Bond. But most people are focused on James Bond and people aren't looking at Moneypenny. And what I think after hearing this is that the real heroes are like Moneypenny and like Dave and here like you, Noelia, who are behind the scenes. You're at the switchboard. You are the ones that are seeing the data that comes in while everybody else is in their Austin Martins and they're going around shooting up, and having all of the front line of it. But the finance really is the Moneypenny. I mean, in her name even is Penny, right? She's counting the pennies behind. And so it makes me think of you two as these superior officers of the different heroes that are out there, like the CEO and these people. And that's an important part to play. One thing that I saw as a real theme is this idea of planning so that you're not surprised, and then actively measuring because a budget is only accurate on the day that it is made. And then that gives you the ability to manage it. And I think for some people, finance is just the thing that they know they need to deal with, but they don't want to look at it because they might just be looking at what's in their actual bank account. But it's a lot deeper than that. And so to have Moneypennies behind the scene, to be counting the pennies and clearly communicating that throughout, especially in a growth phase, because from hearing, when growth comes, it just can mess everything up in a good way or a bad way, right? It either sucks the cash or it brings the cash in. And especially in this scale up phase where you might have equity to carry you through, but at the same time, you can't lose the focus of what is the KPI, what is the individual cost of the user, and how do you actually monetize that? So I feel like you are the heroes behind the scenes pulling the puppeteering between the front-facing figures that might get more credit, but I think credit comes where credit's due, and that's you guys pinching the pennies behind the scenes. I like it.
Thank you.
Thanks very much. I think.
Yes, absolutely. I mean, do you feel like the ability to grow and scale from a financial standpoint, it takes this team, but it takes somebody who's looking at the metrics, who's looking at the dollars, who's looking at these rates of money coming in, where everybody else just seems to be really focused on driving the business, but you're able to sort of give them the updates over the secret walkie-talkie watches and let them know what they can and can't do.
Yes, there is a lot of more behind that because it's for one hand, yes, the tracking is where you see the whole company from a finance point of view. Finance people are normally in the middle of the company and have a view or interface with the rest of the departments because you know what's happening in marketing, what's happening in sales, what's happening in customer service, what's happening in dev, and how much you're spending or you want to spend, and whether it is or not monetizing. It's a lot of responsibility. I've met CEOs that were obsessed with cash and other CEOs that are not so, are more from the marketing or from the commercial side and just delegate everything. But at the end, everything is cash, as you say, money, penny, and you know, if there is no cash, there is no growth, no real growth opportunities. So can you think about a real growth, a real big step of a company without sufficient cash? No, the only thing you can do is little things with your own breath or your own muscle. And this is sometimes too tiny. So tell investors that an investor telling you that you need too much money is to generate a great opportunity. If you don't get the money, you don't go to a big opportunity. So you probably know this phrase like too big to fail. And so many companies with negative working capital and so huge investments like Amazon, they're already generating so much money. It doesn't matter if they're not really profitable. Amazon is, by the way, but Spotify or Zalando, Airbnb, there are so many startups that have injected a lot of cash to be big. And yeah, it's about controlling the cash and making it work for you.
So I have a question for both of you, and this is how we like to sum things up. If you were to give advice to your younger self, what would that piece of advice be, particularly when it comes to finances, having this inside scoop for companies that are scaling up? So maybe Dave, we can have you let us know what your advice is to your younger self, your younger Moneypenny.
To keep a cooler head, perhaps. Okay. Yeah, I think it can be easy to get lost in the details sometimes and lose sight of the big picture, and sort of just get stuck in your finance corner, sort of analyzing some really sort of complicated or interesting facet of the business, or focusing on one part of the business, but actually it's really about being able to take an overall view of everything that's going on and be able to get into the detail when needed, but don't get lost in the weeds. That's what I'd say.
I like it. And Noelia, how about you to finish this up here? What is the best piece of advice you will give to your younger self, which we will all adopt and be more financially solvent because of it? No pressure. No pressure.
No. I would say think big. Think big, budget properly, plan properly, and go to this budget and to these initiatives and measures step by step, so that you can undo or turn or refocus, rebudget, and rethink all your topics and issues prior to a big disease. But think big and get for a big opportunity. And don't be afraid of burning cash for a while. If you are tracking properly, you will see in your KPIs that you will monetize and get it back.
All right. So what I'm hearing is that you've got to think big. You've got to keep a cool head. You've got to budget, scale, and then burn cash in baby steps.
Yes.
Hey, well, it was so fun having you guys on. I look forward to connecting with you. And maybe if you need some high energy speaker to come get your troops motivated, I'd be happy to come fly wherever you are and whatnot. But it sounds like you guys are the people who are the cool heads thinking big behind the scenes in order for it to scale up. So we're excited to have you. It's been a lot of great info. And anybody, if you're watching this now, this is just a taste of the ScaleUp Heroes. And you can see all these episodes on scaleupacademy.io. We encourage you to think big and burn money in baby steps. Here's to everyone's success. And at the end of the day, what gets measured gets managed. All right, guys. Well, we will see you soon. Say goodbye. Bye.